Cathy. You've been down 45% on your flagship ARK Invest. And yet you have a remarkably loyal fan base. You just had a monthly update. Can you explain to the viewers and to your loyal fan base, why should they continue to stick with you when you're down 45% on the year?
Well, I think if we put in perspective what has happened here, you'll understand some of the loyalty. First of all, we give our research away, and I think we get it back in terms of, people believe averaging down into a strategy of ours, believing that we're onto something, some very big exponential growth opportunities. But if you look at the last 5 years, and we do have a 5-year investment time horizon, so let's look back and then forward. Back over the last 5 years, I don't have the exact number, but our performance, our flagship strategy, has compounded at close to a mid-20s annualized rate. And if you look at active management generally out there, I think that only 25% of all active managers in the last 10 years have outperformed. And of the large cap managers, I think it's 11%. So last 5 years, yes. COVID, we got killed going into COVID, and our mantra was innovation solves problems. We started doing a YouTube video. From the trough in COVID to the peak, we were up 360%. And at the end, I was saying, keep some powder dry. Now, down this much, we're saying, if you believed that at the peak, when we expected our total return for the next 5 years to be 15% at a compound annual rate, if you believe that then, what has happened since? Prices have come down, but our models actually, our earnings return expectations have actually gone up. So over the next 5 years, we're expecting, consider the source, it's our research. Our research, I think, is the best in the business, but we're expecting a 50% compound annual rate of return. And
yet earnings returns may not be the most important thing to you right now. It may be the path of interest rates. You were here a little while ago. You said raising interest rates might be a mistake. We had Bill Dudley, the former head of the New York Fed, last week said to get inflation under control, the Fed will need to push bond yields higher and stock prices down. They seem determined. What does this mean for the future of your portfolio? Well, it's interesting. I think the bond market is already sending off some signals. The yield curve, 2s to 10s, inverted last week. That usually means that growth and or inflation are going to disappoint or slow down relative to expectations. So the bond market itself, even though it's backed up, the bond market to this day does not believe that inflation is baked in the cake. It is interpreting what has happened as a series of supply shocks, starting with COVID, all the supply chain problems, which I never would have expected to last this long. And now we have Russia's invasion of the Ukraine, food, energy, we've got labor shortages. Well, I'm going to say the same thing that we said during the depths of COVID. Innovation solves problems. We have more problems now, and I think our ilk of stock is going to do very well if interest rates, even if interest rates back up a bit more. And the reason I say that is we do believe cyclical inflation is near a peak. If you look at last year, this time, April delivered a 0.9% CPI read. Okay, so that's our comparison. And now we're seeing used car prices fall. I think energy even is down month to month. So I think we're starting to see cyclical turn down. Scott?
Cathy, it's Scott Wapner. I so much appreciate you being on Overtime with us today. And I would like to discuss some of the criticism of you and ARK. About a week ago, none other than Morningstar harshly criticized ARK. They downgraded your fund. The headline of their report was invest at your own risk. Among other things, they said you have no risk management personnel, that you've saddled the portfolio with greater risk by slashing the number of stocks that you own. You've called your reliance on your instincts to construct the portfolio a liability. They cited your age at 66, saying you have no succession plan in place, and that you've been careless in avoiding big drawdowns in wealth. This is your first chance to respond on the record. What do you say to all of that?
Well, first, I don't think Morningstar understands what we do. It is very index-centric. we do not use any indexes as a screen for our strategies. We use our research. In talking about our research, he talked about the youth of our analysts and their inexperience in the financial world. Well, as I often say, you can teach rocket scientists or genomics experts, biochemical engineers, how to read and understand financial statements a lot more easily than you can teach MBAs, which most analysts out there are, MBAs about biochemical engineering, genomics, rocket scientists. In terms of another thing that Morningstar does not understand is that our risk management is riddled throughout the organization. I should also say we have a lot of oversight. Our partner, Nikko Asset Management, has it oversees risk from all points of view in our organization. Because it is a minority owner, it has the right to do that. And as you know, the Japanese are very detailed and very focused on risk. So we have eyes from the outside as well as the inside. Our compliance team, within research, we have a scoring system. And we've explained this all to various consultants out there. Our scoring is really about risk when it comes to innovation. Where are the areas you really want to watch risk? Companies, management, and culture. You need a visionary willing to stand up to short-term oriented shareholders. And I would say many of Morningstar's comments were very short-term focused in orientation. You need a visionary leader. We're looking for management changes all the time. We're looking at execution, but differently from other companies. We don't need to get 0.1% to the 0.1 in operating margins each quarter. We want to make sure that our companies are investing enough in R&D and they're investing in the right places. I think that most companies actually are in harm's way, and they happen to populate the traditional benchmarks, right, around which Morningstar has organized its service. So we're making sure our companies are investing aggressively right now to capitalize on these massive opportunities. And it is those companies that leveraged up to buy back shares and manufacture earnings or pay dividends and that did not invest enough in innovation and who are increasingly populating the broad-based benchmarks, they are in harm's way. So we are thinking about risk management every step of the way.
But there are some who suggest that the kind of losses that Bob referred to at the very top of the interview are simply inexcusable, that you take on too much risk, that you've taken too big of stakes in companies and then reduced the number of companies you hold, which only increases the overall risk of the portfolio. Is that fair?
Well, I did put in perspective for you the last 5 years, the COVID performance, the setback, and our expectations for the next 5 years. Our clients have been very loyal to us. We've had net retention last year, $17 billion in net inflows, and this year we're inflowing as well. And I think one of the things that we are doing that maybe others are not is we are very open, very transparent, radically transparent with our research, with our trades. We just held our market update once a month. We do that. Anyone can ask questions. We have a quarterly update next week. We are there for our clients, no matter what kind of environment we're in. And I think that our clients really are looking at the world with a 5-year lens. They see the ground shifting underneath them, and they know that they don't understand everything that's going to impact their portfolios, and they want to hedge against the risks in their portfolios. Many of them have the S&P or the NASDAQ as core to their portfolios, and they would like a hedge. If we're right, those indexes are going to underperform innovation strategies during the next 5 years. And I just want to get back to one more focus in terms of risk management. I have done this. I have been in the business for 45 years. and been around the track, meaning many cycles, I have found that the best way to manage risk in a downturn when it comes to innovation strategies is to basically say to our analysts, and we have 12 brilliant analysts, and to our director of research, Brett Winton, who is also brilliant, during downturns like we've experienced first quarter through this entire last year, we started at 58 names. We now have 35 names in the flagship strategy. We have concentrated towards our highest conviction names. What did we do with the, what about those other 22 or 23 names? Well, our analysts had the freedom as we were going through a downturn. I say to them and to our director of research, okay, now is the time. If there any of our assumptions are in doubt, let's sell those stocks and concentrate toward those names where our assumptions seem to be very much proving out.
Yeah. So you've said that many of you. Go ahead, Scott.
That's a form of risk control, Scott. Many people, but just so that I can say that actually is a major form of risk control. And there's another thing that happens when we do that. We create tax losses. We're selling stocks with a loss. We're buying into stocks which also have losses, usually. And so what we're doing is creating tax efficiency in our strategy. Now, we don't say that explicitly that it's a tax efficient strategy, but during periods of volatility, we use those losses, we create those losses to put against future gains and minimize capital gains taxes.
I can hear the passion in your voice as you defend yourself and you defend the methodology and you defend ARK. And I want to know whether you think this criticism from Morningstar, that of others, the ETFs that are literally designed to bet against you and ARK, do you feel like all of this has gotten too personal? The fact in the Morningstar report they cite your age of 66, your lack of a succession plan, has it gotten too personal for you?
Well, I'll let other people comment on that, whether in our organization or elsewhere. But what I do find very interesting, I've never seen a situation, in fact, Bob mentioned it to me, there hasn't been another situation where an ETF has been created to bet against another ETF. And my attitude towards that is, wow, they are so sure that American innovation is not going to be a sensible place to invest, that they have created a fund to short our strategy. From my point of view, if we are right, and I trust our research, they're doing no research. They're just making a judgment call, I think, on valuations. But based on our research, if we're right, they are going to have to cover their shorts. And I actually just learned that the organization that constructed that ETF has been sold. So there's the conviction in that strategy.
Well, I think they've been merged. It's ASX. But are they really betting against disruptive innovation, or are they simply offering a vehicle for people to do that? I mean, look, you've said repeatedly your companies are going to have 50% revenue growth for the next 5 years, and that over time that's not going to be a problem, and that interest rates and inflation are not going to be a problem over time. But this isn't really a play about revenues or about earnings. It's a play on multiple contraction, which is what happens when you have interest rates go up and you own a portfolio of stocks, many of which don't make any money right now. This is a normal contraction of the multiple. What do you say to people who say it's not about, we're not betting against innovation, we're just saying there is a multiple contraction that's going on that happens historically? Yes,
and if individuals, investors are using another strategy, a shorting strategy to hedge during difficult times, I get that. I just don't think betting on innovation is a long-term strategy. But nonetheless, I understand. But what I would also say is, if you look at the private markets and the valuation of innovation, I mean truly disruptive innovation in the private markets, it's multiples higher. And sure, you're having the odd down round because companies that we don't think are very innovative are losing their valuations. But if you look at others like blockchain.com, its valuation over the past year has tripled, while Coinbase in our portfolios is down 40%. That makes no sense. Coinbase is a far better and well-diversified company, right? And I would argue better managed company. And this is up threefold in 1 year, and Coinbase is down 40%. Does that make any sense to you? I think the private market has this more right than the public markets. And the reason the public markets aren't efficient is they're not doing the research. Everyone is using a benchmark as a screen. By definition, S&P 500, 28% in tech, we own none of them. We don't think those are the disruptive innovators. So the people who are benchmark sensitive, benchmark aware, benchmark hugging are doing their research around the benchmark companies. Our companies, for the most part, are not in benchmarks, not in the broad-based benchmarks at all. And so we're really offering something highly differentiated, as many large cap growth portfolios out there are starting to look more and more like each other and the benchmarks. They have, up to 50% in the FANGs, Microsoft, NVIDIA, and our beloved Tesla. Tesla, we think, has miles to go and is truly disruptive. We don't think the same is true of those others.
Okay, now, Cathy, this is Scott again, when you start talking about Tesla, yeah, I obviously think of Elon Musk. And because I think about Elon Musk, this week I think about Twitter. Now, did I see correctly that you sold some Twitter the other day? Because when Elon said he was joining the board, I literally thought to myself, I wonder if Cathy is buying more Twitter shares on that news. And then when he decided he didn't want to be on the board, maybe Cathy was then selling part of the position. Can you just tell me exactly where you stand on that and your view, given your view of Elon, how that played into it, if at all?
Yeah, well, we use Twitter pretty intensively. We give away our research. We're out there commenting all the time. I think it's a powerful public town square, or global town square, as Elon calls it. And, maybe the model isn't right around advertising. Maybe it is subscription. I don't know what is exactly in his mind. But one thing for sure is in his mind is it should not include censorship. And I think he feels very strongly about that. In fact, I know he feels very strongly about that. He's out there all the time talking about it. And I think what he did in Ukraine with Starlink, basically getting that information out. It's awful to look at, but it's delivering a message to the rest of the world that they would not have otherwise. And so
but did you
I think he's
did you cut the position though, or did you sell in recent days when he decided not to take the job on the board? Was that a deciding factor for you?
No, we had been cutting back on Twitter after Jack Dorsey handed over the reins. We had been selling, and we know there is now going to be a lot of management distraction, and maybe board distraction, with or without Elon. He's going to get his message across probably even more effectively not on the board, which may be the reason he is not going to be on the board. So I think there's going to be some drama, and we don't know if the advertising model, the subscription model, some combination of that is going to prevail. There may be some dissension in the ranks, but when we see management change, and again, as part of our risk scoring system, when we see management changes, we tend to act if we are uncertain about the ramifications.
You are down to 35 stocks now from
35.
About 60. So it's a concentrated portfolio. Give us a sense of what you're looking for next. What company, and if there is a company, please tell us, that might be the 36th company on the list. What is there one, and what would be the parameters of what you're looking for right now?
Well, first of all, if I can use this moment to say, I thought you were going to ask me a different question that I'm going to answer.
Sorry.
And no, we're going to put out a refresh of our Tesla model on GitHub this week. And here is a good way to control risk, as speaking to Scott again, and to you, of course. Putting our models out there and having people basically argue about our assumptions is a really good way to control risk. If we're making an incorrect assumption now, we want to know about it because we're looking at exponential growth trajectories, and we're going to do this with Coinbase, Zoom, Exact Sciences, and Roku in the next few months. We are open sourcing our models.
So wait, you're going to explain the rationale about why you own them and what the models look like. If people want to change the assumption on your models, they can play with your model.
Yes,
they can use a Cathy Wood model to figure out their own portfolio.
If you think about this, the first time we put out our model, I can't remember the exact year, but people just didn't believe it, the numbers we were using. And lo and behold, what did Tesla do? Not only did it not run out of cash, but it was able to scale manufacturing after all, and now is taking a huge share of the market, 60% plus in the United States, right? So those, in terms of next steps, you know, some of the names that we sold during this concentration period, we will be getting clarification in terms of some of our assumptions, so we may go back to them.
Yeah. Cathy, real quick, a stock that looks to me like you just bought recently, and maybe it's the first time you've bought it, is Blade. $8 stock, and to Bob's earlier point, doesn't make any money. Is this really the time to be buying unprofitable companies?
Well, they just got another contract today to fly from LA, I believe it is, to the maybe Coachella. So I think we're beginning to see signs that you know, people would they're willing to pay for time, right? People value their time increasingly, and so I think anyone thinking that this is going mass market anytime soon, we're not thinking that. We think this is going to scale over time because with autonomous vehicles, the costs are going to come down to get from point A to point B. Congestion's going to increase, and Blade will be in a beautiful position to take advantage of that.
I know you got to get going. You're going to be speaking to the conference attendees in 10 minutes.
With
Cathy
you?
Wood,
Yes.
ARK Invest. Thank you. Very generous with your time.
Thank you,
really
Bob.
very
My
much
pleasure.
appreciate it.
Thanks, Scott.